right, welcome everyone. Hello, this is our October 14th, 2010 FXDD and FX Street co-production. It is our Forex training class. Our disclaimer is we do not give buy, sell, or hold recommendations. Trading is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle. Okay, so we're going to do another anticipating the Forex trends. This is going to be really exciting. We're going to be talking about trading during a key economic release or on release days. Well, we've got Greg Michalowski back with us. He's our FXDD Vice President. He's the Chief Currency and Trading Analyst at the company. Many of you know him from his work on our commentary pages at FXDD and his work on FXStreet.com. You can get Greg on his Twitter at twitter.com/GregMikeFX. I'm along for the ride. I'm Sean Powell, one of FXDD's national trainers. I'll be helping Greg with questions as we go through this 1-hour training. My Twitter is Sean Powell FX.
And good traders will always be concerned more about that second part, the risk side of the equation, than the first part. The first part will take care of itself if you control your risk. If you can control your risk and stop the big losses along the way, you're going to find some nice moves as well, and hopefully those are nice trend moves that'll give you a decent profit in your trading. So with that said, with that mission statement, and especially that idea about the least amount of risk, before a key economic release, what happens to risk? What happens to risk? And I think everyone would agree that that risk will increase because instead of just having market risk, traders have also added event risk and liquidity risk. Event risk and liquidity risk. So not only do you have the market risk that the market may go up or down, and we have that at all times in the market. That is a risk that we cannot get rid of, but we also have this idea of event risk. Now, we don't know what the economic data will be or how it's going to come out. All we know is that there's an estimate of the economic data, and that's all we have to go on. So event risk increases and liquidity risk increases as well. What is liquidity risk? Well, after a key economic release, what does the price do? It goes up and down like a yo-yo at times, or it can be moved in a gapping motion in one direction or the other. And this may prevent you from trading, getting out of position at the price because you may have the risk. I'm losing the idea of the risk. Where you have a gap and you can't get out. It's escaping me. Anyway, that the risk of not getting your stop loss done at the price that you expected, that is all added risk. That's liquidity risk. That's going to make your risk increase. And so, what traders have to do is account for the added risk. You have to account for the added risk, and the reason is because risk is not static. It changes. It's dynamic and dependent on different factors like event and liquidity risk. And most retail traders or retail traders that I find don't do well in their trading will have this situation where they consider the risk the same all the time. They will take the same position no matter what is going on in the market, no matter what the event risk, no matter what the volatility in the market. They're always going to do their 1 lot or 2 lots or 5 mini lots or whatever. And that is not really the case. There are different levels of risk in traders, and it's not static. It's dynamic. It changes. It changes all the time. So you as a trader should be aware, especially during economic releases, that not only do you have market risk, but you also have liquidity risk and you also have the event risk. And as a result, you have to adjust your trading accordingly, or you should adjust your trading accordingly. So for an example, so before I get to the example, so what you have to do is you should at least, at the very least, lower the amount that you trade. Why is that? Because the greater the risk, the greater the chance of losing more money. So it's as simple as that, folks. You have to control your risk, control those huge losses that are going to cause your account to lose a lot of money in a quick period of time. So now let's get into the example. And the example is this. If you have a $10,000 account, what most money managers will do. Professional money managers, they won't risk more than 3% of their account on any one trade. 3%, that's it, folks. So 3% of $10,000 comes out to $300. And so if you normally do one lot with 30 pips a stop loss because you trade a key borderline levels like a moving average or a trend line or against the Fibonacci retracement line, and we'll go through a little bit of that later on in the presentation. You know what your risk is. As Ed said, you have to prepare for the trade. You have to know what your risk is, and if you define your risk, then you have less fear, and if you have less fear, that's good for your trading as well. And so you now let the trade happen. So if you normally risk 30 pips as a stop loss to do one lot, and that it will equal your 3% risk on the 10,000 account, you defined your risk. You should do something less for if you have increased event risk or increased liquidity risk. So just in a simple example, if you anticipate that your stop is going to have to be 60 pips away because it's a non-farm payroll release, and the market can easily gap 60 pips, but you're just going to use that as your proxy for the risk, then you should do half the amount that you normally do. You should do 0.05% of a lot rather than one lot, and that will equate to your loss of $300, 3%. That is your risk. Now you can focus on what the potential gain might be. The other thing that increased risk does is, I mentioned it just a second ago, it does something to a thing called fear. And for me and for you, fear is a trader's worst enemy. Fear makes traders do things that they normally would not do. I have a saying that I tell all our customers, and that is steer clear of fear. If you can control your fear, you are a step ahead of the game. You are able to do things with a clear mind. You are not going to be forced into a situation where your fear is so great that you do a trade that you really didn't mean to do. And I know I've been in that situation. I know probably a lot of you have been in that situation as well. And when you talk about a key economic release, what happens to your fear during key economic releases? I know for me, my heart rate always increased, waiting for that non-farm payroll number to come out. The beats start getting a little bit quicker, and your anxiety, you're anxious. You are waiting for the number to come out, and then it comes out, and you are still anxious through the economic number. What is the market event going to do? So your fear increases, and for me as a trader, I want to steer clear of fear. So that's another thing to consider. And another reason why, if you are going to trade during an economic release and have a position, that you should, at the very least, have a much smaller position, because you have to take into consideration this idea of fear. Now, the other thing about event risk, especially during an economic release, I mean, let's lay it on the line here, folks. Event risk is sometimes like betting red or black. You have to ask yourself, is this trading or is this gambling? And if you want to gamble, I suggest that you go to this casino and bet red or bet black on the roulette wheel, because it's not out to go. So I've kind of moved a screen change the thing here. Hold on one second. Where am I? There we go. So I'm going to hold. If you can beep green off, put it in another. There we go. This is the Bloomberg screen going back to the non-farm payroll announcement that occurred on last week on Friday, and this obviously is one of the key economic releases that causes anxiety, increases fear. And what I mean by the gambling idea is that when you look at the non-farm payroll, here is what the survey results was: a change in 5,000 jobs to the negative, a change in private payrolls of 75,000. Those are probably the most important factors for any sort of release, including for the non-farm payroll. The unemployment rate is also known as well. But for you as a trader, for you as a retail trader, the estimates from the economists that are polled by Bloomberg, by Reuters, by whatever news service comes out with these estimates, and this happens to be Bloomberg. These estimates are the best that you can do. These economists that they poll have all the tools, they have all the modeling techniques in order to figure out what non-farm payroll is going to be. So when someone asks me, what do you think non-farm payroll is going to be, I put on this page and I say it's going to be minus 5,000. Why? Because I don't have all those tools. I don't have all that knowledge to say that it's going to be weaker or stronger than expected. And people who say, who aren't trained economists don't have to, and I think the non-farm payroll is going to be weaker than expected. As Ed said, they're just gambling and kind of walk away from them because they don't know. They don't know any better than the PhDs at Goldman Sachs, the PhDs at Credit Suisse, First Boston, or Citibank, or Deutsche Bank. These guys know it more than anyone else. And even they will say it's a difficult number to guess, but this is the best that we can go on. So if you're going to make a bet on the non-farm payroll, you are in effect saying that it's going to be different than what the estimate is going to be, because the market is going to discount what the estimate is going to be. And so you are in effect saying that you know more than what the PhD economists out there know. And I know that's not the case. I have come to that realization myself that is not the case. So what I will defer to is what the non-farm payroll will be. And I look at it more of a gambling type thing, a bet in red or bet in black, rather than a market or trading decision where I'm in control. I'm not necessarily in control when the non-farm payroll comes out, because you know what? There's 300 million people here in the United States, and a 50,000 or 100,000 difference is going to cause the market to go one way or the other in a violent action. I consider that more of a gamble rather than a trade. So I'll be even more conservative in my trading during the non-farm payroll, and I suggest that maybe you start to look at it in that respect as well. So the other thing that I warn people about, and what has happened to me as well in the past, is that I could give you what the U.S. employment data would be, and it might be difficult picking which way the market would go. It's not necessarily a guarantee, as you know, is going to move in the direction that it shows all sorts of different factors that go into a value of a currency pair, and the market can move either higher or depending upon what it's focused on. You have to remember that a piece of fundamental news like the unemployment number is just one piece of the of news that goes into this cauldron that's called fundamentals. There are other things like central bank trade, and even the Fed ignored the quote-unquote stronger than employment current month, and they started focusing more on quantitative easing and increasing quantitative easing, and that caused the market to go the other way as well. So you have to be careful with key economic data that the market doesn't necessarily do what you want it to do. So what another alternative, instead of trading, having a position through that, actually wait. And wait for the event, and is the amount and prepare after what may happen. That is not a gamble. That is a chart. And in order for you to do that, you have to prepare. As Ed said, you have to know and have an idea of what the price and the tools that you're using are going to be telling you about the market. And if you prepare, if you're ready for that, then you can better trade these economic releases. And perhaps make the most amount of money with the least amount of risk. So with that introduction, I'm going to take the screen off of the PowerPoint here. I'm going to go to my charts, and we're going to take a look at an example on how I actually look at the market before an economic release, and then perhaps after the economic release, what kind of trading decisions I may have at that point. So I'm putting it on my chart here. And this is the euro versus U.S. dollar, and this is an hourly chart for the euro versus U.S. dollar. And this is just prior to the employment number. I've kind of cut this off on the 8th at the point right prior to where the economic release was coming out. And the first thing that I want to point out is, or the first thing that I do when I look at these, when I prepare for an unemployment report, is take a longer-term view and see where the market has been, where we are, where we stand from a technical basis. I am a firm proponent of using technical analysis, as probably most of you are who visit this site. And what you have to do is use the tools that are available to you in order to give you the bullish or bearish bias. And that's what all technicians do, is to try to determine, is the market bullish, is the market bearish, and where is the risk, and where am I wrong given these tools. And without tools like technical tools, you don't really have an idea. You can pick any point, any price along this point, right, along this chart here. Let's say this point right here, and you don't know what your risk is just by looking at the price. But from if you put a trend line in against that line, you know that your risk is if the price goes above that line. So you have an idea that you can sell against this trend line right here, and hopefully the market will go down. When the market comes back down to this trend line at the bottom right here, you know that, well, I can buy against this level, and what is my risk? My risk is if the price goes below the trend line. So if you buy at this point, you are limiting your risk, and you can have the market, if the market holds that level, and you don't know, you can't predict whether it's going to go below that line or not. What you know is that your risk is only to this point right here, and your reward is if the market moves back higher and moves up to the upper end. So going into the employment report, what I'll look at is this chart, and I'll define that risk. Where is my risk on this trade? And also where, if the price goes to a key technical level, where would I be interested in executing a trade after the event, after the liquidity risk is lessened, after the event risk is gone, and then look to benefit from that knowledge of and preparation in figuring out, okay, where can I make money trading? So I'm going to zoom in a little bit here and get back up to the 8th here. There we go, right at this point right here. And you saw the big channel that we were in prior to the economic release. Note that the day before was actually a key day and a key opportunity for traders who are anticipating the employment report to actually get to put a decent position on. Why? Because the market was against this top trend line right here, and look how the market held that top trend line at the highs for the day. It held it like a charm. The market found sellers, and the market came back down in between our two channel points right here, and it finished the day, as a matter of fact, right in between the high and the low channel point. So the market is already preparing itself. The smart traders are already preparing themselves by selling against the high here, forcing the market to the downside, getting in the middle, and being prepared for anything that might happen before or after the economic release. And oftentimes, the non-farm, as we go into the non-farm payroll report, the market, in its wisdom, will move the price to a level that's in between a key support or a key resistance level, and they actually make it easy for themselves by doing that. I don't know how they do it, but they it ends up being that way. So by that, what I mean as well is that look how the market during the London session on the day of the unemployment number came down. I got to hide this, of course, away from here. Came down, and where did we stop? We stopped right on the trend line, right on, and this blue line, by the way, this moving average line, is the 100 bar simple moving average. I'll click on that. Show you the what it is. 100 simple close. I put it as blue. So it came right down to key support. So in the 24 hours prior to the unemployment report, we tested the upper trend line, we tested the bottom trend line, we held that side, we held this side, and then the market started to move away from the where the support was, where the key support was for going into the economic data. So it was giving itself room to the downside to let the number and the event risk and the liquidity risk rid itself through the market and then start its move either to the upside or to the downside. So coming into the number, the way that I do it, with no position on whatsoever, I will simply look at my risk and start to analyze where is the key technical levels that I can prepare for, that if the market should break or hold or either any of these levels, it would turn the bias from bullish to bearish or bearish to bullish. So, and I'll do that, and I'll straddle the market either to the upside or to the downside, or both to the upside and to the downside. So in this case, the market is trading somewhere around the 138.80 level, maybe let's call it 138.90 level, and I have certain lines across this chart, and I also have the trend lines and I have the moving average lines. Obviously, the key trend line and moving average is going to be average, and then perhaps even move down to this line at 136.34. So from on my trading blotter, I know that okay, here are my levels on the downside. Get through this line, get through the trend line, get through this low from 2 days prior, get to the 200 bar moving average, and then come down to this 136.34 level, which happens to be these lows right here, and that's in modal. It's got to get through this level, it's got to get through this level, it's got to get through that level, and as long as the market can continue in that direction, the bias remains to the downside. On the top side, what are the levels that we have? Well, close by is the low here. We moved up to a high, came down to the low, and then moved up to our high that that tested the top trend line. So I put a horizontal line across that level. The next obvious level is this high. The market came up to a high, came down to the level, broke, came up to the high here, and then broke through the level. Did not trade a lot of volume at this level, moved higher when the market came down through this level. Where did we stall and start to move to the downside? Right at that level again, and on the day before, or on the day of the non-farm payroll, we moved above for a couple hours and then moved below, and notice these 2 hourly bars, high at that level, high at that level. Is that level a key level? Yes, these are obvious levels that the market gives you, folks. It gives you an idea of what you should do if the market should go above that level. The next level up here is 138.91. That level corresponds with this high right here. We were above that level for less than an hour, and the market moved down. So that becomes another level. And you start to use these upper trend lines, and so you start to get your levels in place. You can also go to the 5-minute chart and see if there's any clues from the 5-minute chart that you might want to hold on to. And in this case, I use a 5-minute, I use the hourly, I use a daily chart. If you go back in time, you take a Fibonacci from the low to the high, you can get a 50% retracement level at 138.32, and you might be able to refine some of your other lines by using that 5-minute chart. So with that knowledge in place, you're now prepared to trade. As Ed Ponzi suggested, I can't tell you I know where the market is going to go. All I know is I can define the risk in the market, and and I can define a bias. I can use tools, and good traders and successful traders will map out the road. They'll map out the route before a key economic release. Let the event risk go. Let the liquidity risk disappear. Should that have turned the bias to the downside? Yes, it should have. Did the market stay down there for long? 5-minute chart here, but in just a second. So when the market doesn't do what it should do, then you should close it probably and look for the counter trend to or move back to others. So by knowing this level, this key level here on the chart, you're prepared to either be a buyer on a dip here, or to take advantage of that move, or to get out of your position and move and take advantage of the move back to the upside when the market moves back above this key level. This obviously is the most important level through the economic number, because not only do we have the trend line, which extended all the way from September 10th. This was a channel that is for a book, to be honest with you. But it was such a key level here for the euro versus U.S. dollar, and so and not only from an hour, 100-hour moving average reason, but also because of the trend line. And the market then moved to the upside. So we know that level kept in place. We also know that the upper side was not extended as well. So as the day progressed, what we found out was that all the action was in the first hour here, and then the market moved or consolidated. But let's look at the 5-minute chart and so take a little look at this and see how that progressed for the day. And you can see here that the market initially after the 8:30 release, this is 8:30 right here, this bar right here, the market weaker than expectations. So what we saw was the euro rally sharply to the upside here, and we hit our high. And where did that high fall short of? The high fell short of our top side objective here of the 139.92 level. The market went up to a high of 139.82 and then started to sell off. Now, you as a trader, if you have a line going across here at the 92 level, if you see the market move sharply to the upside like this, do you have an opportunity to sell against this level right here in anticipation that, well, the market's going to rotate back to the downside, and also I can define my risk? Of course you do. You have this idea. If you know that the 92 level is going to be a key resistance level from looking at the past, looking at the key technical levels from this point right here where the market came up, moved up, and then fell through that level, that's a key technical level. If you know that that is going to be resistance, you can be prepared to sell against that level after the event, after the risk, and take advantage of any sort of move that might go to the downside. Now, we don't know that it was going to move all the way to the downside, but what we do know is that this is a key borderline level. If the price moves above, your stop is in place, and you can risk 10 or 15 pips on that trade in the hopes that this level holds and the market moves down. So that's one thing why you should be prepared, and why it makes sense to map out the plan going into the economic release. Now, what happens subsequently is that the market then falls sharply, and we do the whole 100%, more than 100% retracement of the initial move to the upside, and we go down to our key support level. We go down to that line where the 100-hour moving average is, and where the trend line comes into place. And in this case, with this sharp move to the upside and sharp move to the downside, obviously you're going to get those traders who aren't prepared selling like crazy because the market's in a free fall here in the 15 minutes after the high is released. Let me move back. I'll zoom. Oops, sorry about that. There we go. But you're going to get those traders who aren't prepared, who are going to be selling through this number. You're a buyer down here because you know it's key support. Where's your risk? 10 or 15 pips below the key trend line. Does it ever get down to that level? No, we go down just a few pips below that key support level and then rocket back up to the upside. So you as a trader, if you had these levels on the top side and the downside in place, you could have traded that non-farm payroll number and been much more successful than someone who bet red or bet black that the market was going to go or the number was going to be weaker or the number was going to be stronger, and the market would either go to the upside or come down to the downside. And the other thing that I do want to point out, of course, is that getting back to that point where I said that I could give you the number, I could tell you that the non-farm payroll is going to be weaker than expected, and then you could actually know that number, but you could not ever be prepared for this type of move. And this is a type of move where you as a trader, your fear is increased. So you know that the number is going to be weaker than expected, and that the dollar is going to get that dollar should get weaker, the euro should go higher, and you could trade it that way, and you'll be all happy at this point right here, but 5, 10, 15 minutes after the release, you're back down to where the market started, and now your fear is increased, and you are the one selling at the lows, only because you knew that, you knew the number and coming down. So you never know which way the market's going to go. What you know is you're going to have that fear carrying the position through the number. The best way to do it in my book is to not have that fear, not take on that added risk, and instead look for those opportunities, map out that plan, find those levels where there's key resistance or key support, and trade against those levels, and see if you can take advantage of the counter trend move, or in this case, what should have been the proper move to the upside for the currency pair, buying at the dip and taking advantage of this move to the upside, and then calling it a day and starting over the following week. So that concludes my thoughts about trading at economic release points, and it doesn't change for any other release. If you think the number is going to be a key economic release, understand that if you think that's the case, whether it is or not, whether you get a sharp reaction or not, that at the very least, if you think it's going to be key, your fear is going to be increased. And if your fear is increased, I always suggest to traders, or especially retail traders, that what you do is define the points along the way, define the map to the bullish and bearish side, and use those clues to guide your trades after the event. And that way you won't have that fear. Your fear will be less, your risk will be less, and you stand a better chance of making the most amount of money with the least amount of risk. So if there are any questions, Sean, I will be happy to answer them. So put in your questions into the window here, and we'll go through them.
Fantastic, Greg. Just to let you know, that was a great presentation. I think everybody's enjoyed it. We did have one question come in before you start answering them. Someone was asking the name of your upcoming book.
It's Attacking Currency Trends. It'll be released in the first quarter of next year, as far as I know, and it will it'll include things like this, and it's going to, it's geared toward the trend type moves, this type of trend move, and I really look forward to it coming out. I think it'll be a benefit to a lot of traders. It incorporates a lot of logical things similar to what I just went through here this morning.
All right, fantastic. Now, we did have one more question, then I'll let you get to those questions. Someone is asking, Iberetz is asking, if you think that the market will continue to the upside. Mm-hmm. And I guess I'm assuming he's talking about the euro versus U.S. dollar. All
right. Well, let's take a look at the market right now and see where we stand from a technical perspective. Like Ed said, and I love for those people who listen to Ed, I am aware what you think. All right. That's rule one that I learned ages ago, is that what I think doesn't really matter. What the market that now better approach the market in a more rational way, and that's where I started to use tools, started to use things like trend lines and moving average. Moving again, my 100-bar moving average. Look how the market held the 100-bar moving average yesterday and moved higher. Is that a significant technical level? Yeah. And did the market follow it? Yeah. Did the market follow the 100-bar moving average here? Yeah. Did the market follow it here? Oh, it went below the moving average, but came to the trend line. When we moved back above the 100 moving average, it moved higher. This trend line, did it hold that trend line? Did it hold that? Yeah. It does these things. Did it hold this? No, it broke below, but you can imagine the traders who are selling here, it's going lower. Nope, going back higher, folks, going back to that top trend line right there. These are clues that the market gives you, folks, and it allows you to control your risk. Hold the trend line here. Do we hold the moving average line here? Yes. So yesterday, when the market held the 100-bar moving average, 100-hour moving average, simple moving trade here, the market ran out of buyers against that level. Why? Because the risk was about 15 pips here, and if you take the same risk to the upside, you could make a multiple of that move to the upside. So I'm not surprised at what the market did. But so the question becomes, more like this perspective. We have this mass that's up, and the market that has remained in the top part. Now, what I will do, or to get to the answer here, is that when I see a sharp move like this to the upside, and you can do it. I'll do it here too. This is a sharp move, a trend type move to the upside, and where did the market? Let me get rid of this line here first, and I'll show you. I'll give you a little idea here. So the market moved up to the upside here, right here, and then we started this correction. Not only did we have the 100-bar moving average here, but what else do we have here? the 38.2% retracement of this move to the upside. This is standard technical analysis, standard stuff that happens in the Forex market all the time. That's why I like Fibonacci's. That's why I like trend lines, like moving averages. So not only do we have support from the 100-hour moving average, we also have support from 38.2% retracement. When you have more than one reason to buy the market, buy it. Or if the market should go through that level, make sure you sell it. That's a key borderline level. So now let's take this move to the upside and go to the top here. And where do we come down to here on the correction down today? We came right down to the low for the day came in at 46. What level is this? 140.41. So once again, a key borderline level here, folks, for traders to buy against. So we found the buyers at 46, 47, 48 with a risk below the 41 level. Now, we all know that the market is overbought, but unless the market gets below this 38.2% retracement line, the bias remains to the upside from a bullish perspective. And this was actually the level that you should have been buying at. What do you do here at 82? I'm not sure, to be honest with you. We are back to the underside of that trend line, so we are finding some resistance. It looks like we're trying to move to the upside here, but the real trade here is the low risk trade, and that was against the 38.2% retracement line. And if you did that, you have been in better position to move to the upside. Now I'm going to look at the 5-minute chart and see if that's giving us any clues. And off the 5-minute chart, we're trying to move above the 100-bar moving average. This 100-bar moving average is moving sideways here, which indicates this non-trending type motion that we've had here over the last 100 bars. And so the market is kind of waffling back and forth a little bit here on which the bias would be. But this again was the buy opportunity against the 41 level, move back above the 200-bar moving average, and that's where you had to move to the upside. Let me see here. As a swing trader, I find key level in place, a limit order with trend direction, but whenever there is a pending economic release, I reduce my position size as uncertainty. However, I do realize that this kind of strategy placing orders hours before release has its flaws. Would there be a better timing to do such? Reduce my, how I do realize this kind of, whenever there is I reduce my position size as uncertainty. However, I do realize this, pending economic, place limit orders. I prefer Irvin to. If I'm going to be there, I want to push the button myself to execute the trades. The reason why free fall, I would more, and if I know that at $1. So I want to, but I understand that there's going to be this illiquid trading in the first part of that period. So I'm more prepared to trade the failure, or to look to buy in this area right here where it's above this old low right here, than to put a limit order in there, because you never know what, I'm a more of an idea that, okay, show me that it fails, first, because the market can go wherever it wants to go, and then look to get in on that move. So that's what I prefer to do. So do I set limit orders? Like I said, it's a personal preference. I choose to push the button myself. What's my intermediate term bias for the dollar? Again, I defer to the charts for analysis here. And what I could say here, and the reason why, here's the point, folks, is that remember when the market was down here at 118.76 or 119, and what was the conversation at that point? The conversation was that the euro is going to parity. All right? Now, to go from 118 to parity is 1,800 pips. All right? But you turn on the TV, and there's all these people saying it's going 1,800 pips. That doesn't make sense to me from a trading perspective. The only way, and it just makes it almost laughable to me. I mean, let's get through 115. Let's get through 116 first. I am a trader that goes from point to point to point, and as long as the price can remain on that trend, as long as the price can remain, and I'll bring up this chart again. As long as the price can remain above the 100-bar moving average, as long as the price can remain above the trend line, then I'm going to be bullish in the market move. Now, where do we stand now? We had this correction here that took the price below the lower end of this channel trend line that's been going on for a month. All right, so there's a little crack in the armor here for the euro versus US dollar. I'll just talk about the euro, okay? So we can look at other currency pairs and make the same judgment. Now, the good news is that the price yesterday came above, the price came up to the underside of that trend line, tried to get through it, and today we went above it, so we got back within the channel trend line. I think that's a significant thing, but we've had the market move back down to the 38.2, and we're at this 140.86. So from my perspective, is that as long as the price can get back within this channel, then the bias is to the upside, and we could see this market continue up in this direction and head up even to the upper end of this channel resistance, if the market can stay above that level. If the market doesn't stay above that level, guess what? The bias is now to the downside. We're now back below the underside of this significant trend line here, and the bias turns to the downside. And so what I do as a trader, and what I suggest you do as a trader, is not to have an intermediate idea that the euro is going to 150 or the euro is going to 130. Get yourself to the point where you sell against the borderline right here, for instance. You get through the 38.2% retracement. That gives you confidence. You get through this high of the week, which came in at 11. You get through this peak high that happened yesterday and this 61.8% retracement of this move to the downside, and you feel more confident. You get through the 100-hour moving average. You get through the 200-hour moving average, and next thing you know, you have a trend-type trade. That's the way good traders do trade, is they go from point to point to point. They don't go from 118.76 to parity. That's not the way to do it to be successful as a trader. You start off with a trade, and then you get into your investment position. In closing, I'm reminded of what Dennis Gartman said on CNBC about a few months ago. He was asked about gold, and he said that his gold, he said that he was long gold from a number of different, in a number of different currencies. He's long gold against the euro, against the dollar, against whatever. How he got all those positions, I don't know. But what he said was that his position started from a trade, and for you as a trader, that's where it all starts. It all starts because you have this borderline here, and you say that the market can't stay above this level. I'm going to sell at 140.80, and my stop is going to be at 140.90. And so you start with a trade with a small amount of risk, and then you move down, and you watch the market get to the 38, get through the 11, get to the 61.8, get through the 100-hour moving average, get to the 200, and now you have an investment. Now you're long gold from the lows. And that's the important thing to realize as a trader, is that it goes from step to step to step. Intermediate doesn't mean a thing to me. What matters is, what is my risk now and where am I going? And then you start to manage the risk. You take your profits. You don't have that fear because you're in a trend position that goes your way. So that does it for me here today. I appreciate everyone for coming out here today and hearing a little my.
Well, that was a fantastic training. I think everybody's enjoyed it. We can see all the comments coming in the chat room. Everybody, just to remember, we do have an 8% bonus going on right now at FXDD. All the details at fxdd.com/FXStreet, and we will see you on the next one.